I'm sure my next guest has his thoughts on the subject. Please welcome to the show, Eddie Ghabour. Eddie, thanks for being on. I follow you a long time. This is your first time, but you're fantastic. So I don't know what you thought about what I had to say there, and if you have some issues with it, go ahead and take them, but that's my thought.
No, look, I agree with you. I think the Fed is very clear. We were pounding the table last year saying that if they didn't raise rates, that 2022 was going to be extremely problematic because they were going to have to play catch up. And now they're in a lose-lose situation. They've made the biggest policy error in history, in my opinion, by not seeing the inflationary problem that was crystal clear to so many. And now, in my opinion, they're going to drive us into a recession because they seem to be hell-bent on doing 50 basis point hikes in May, potentially June. The bond market has 8 to 9 hikes priced in. I don't believe they're ever going to get there because I think the market will either be down by 25 to 30% by then, or the economy will be so slow it's going to force their hand to pause. So we're playing strict defense right now because this is one of the worst setups that I've seen in my career in regards to risk assets, and reminds me a lot of 2008, to be honest with you.
Yeah, I mean, I totally agree, and that's what I said before we opened the show. We have to be careful. We're total agreement here on this one, and I don't want to be too much of a Debbie Downer, but there almost isn't a way out, if you know what I'm saying. There isn't an easy chance here, and I would say, I'll let you talk after this, but the question is not hard or soft landing. It's just how hard of a landing.
That's exactly right. And look, when you look at, and this is why I've been trying to tell investors that now is the time to be playing defense and not try to be a hero and pick a bottom and take a lot of risk right now. Because if you just take a step back and look at it from a common sense standpoint, they pumped in a tremendous amount of liquidity into the system. They kept rates really low, and that caused asset prices to hit levels, highest levels ever. And now they're going to do the opposite. So what do you think that's going to do to those same assets that inflated? To me, it's a no-brainer. We'll have to wait and see. That's my opinion. We're not consensus. I'm seeing a lot of smart people that think the bottom is in and that we can have a soft landing. I am not betting my client's future on the Fed making a right decision, because when's the last time they did that?
Probably before I was born, maybe. Or maybe, I'd say Volcker was probably the last one that did something meaningful. Yeah, and so this is where we sit. So this is a really hard question to ask you, and I can't believe I'm doing it because I would hate me if I was you. But, I mean, what do you think about timing on this one? Where and if would we start to see these big ripple effects start to happen?
I think they're going to start. I think they're materializing right now from a downwards perspective of the market. I think after we get the first rate hike and they actually follow through with that in May, I think the second half of this quarter is going to be very treacherous. And I think we're going to see the S&P from peak to trough at a minimum down 20%. And I would probably say it's going to go down more than that. But I think we're going to see a minimum of 20%. And the earliest, in my opinion, based on how we're looking at things, that the Fed will probably pivot and maybe pause on rates will be late third quarter, early fourth quarter. By then, there'll be a lot of assets that are down quite a bit, and that's when we'll probably look for some opportunity. But these next few months, in my opinion, I think you're going to see the VIX close to 40. And I think you're going to see the 10-year yield start to actually go down because of the material slowdown we're going to see economically. I don't know what they're looking at. Consumer confidence is plummeting.
Yes.
Business confidence is plummeting.
Yes.
GDP is going down.
Yep.
Discretionary spending is down. And you want to tighten into that environment?
Right.
It makes zero sense.
I've been doing this for 35 years, Eddie. I've never seen the Fed tighten into a weakening economy. At the same time, not even weakening economy, you've got the Atlanta Fed coming out and downgrading GDP growth now to 0. So that's my problem. You think you're going to carve out in just inflation with raising interest rates and not hurt anything else? I mean, what kind of medicine to a human being has ever done that? Nothing. If you want to kill something bad in human, you got to give medicine that hurts a lot of other things in the human body. So I just don't understand how they think they can carve out inflation with interest rate hikes that aren't going to hurt mom and pop or a lot of viewers of this show, because these folks have operating loans for their businesses. It's going to get more expensive if this is what they really want to do.
It is. They're going to kill this economy. And I would argue we've already seen a huge hike in rates already. So they've already done the tightening without having to raise rates but 25 basis points. So I think it's a big mistake what they're doing. They're so late to the game. They're trying to save face. And all they're going to do is make last year's policy error even worse by making a bigger policy error in 2022.
One last thing I want to ask you is that we haven't really seen this happen in the employment market yet. But if we start to see the economy slowing so much so that we start to see job losses, even though we've got 11 million unfilled positions, I think that would be a huge red flag.
It is, and I think that's what will ultimately happen. When you get to peak wages and you get to peak unemployment, that usually is the last part of the cycle, right? So you know we're very late cycle. And then the job losses come towards the end. And frankly, by then, the damage is already done economically and in the market. That's usually when you start getting closer to a bottom.
All right. You couldn't have done a better job on your first time on. That's fantastic stuff. We're definitely going to have you back. That's great. That's Eddie Ghabour. Thank you very much, Eddie. Thank you for being on the show.